Hello everyone. Today our group will be presenting our project on JP Morgan Chase, one of the largest and most diversified financial institutions in the world. My name is Shreya and I will be presenting with Tevin and Dewan. Our project has two main objectives. First, to select a publicly traded fintech company or bank, and second, to evaluate its management strategies and investment portfolio. To do this, we structured our analysis into 7 steps: interest rates and term structures, stock market and equity valuation, mortgage fundamentals, foreign exchange, efficient markets, banking management, and venture capital and private equity. Together, these steps give us a full picture of JP Morgan's exposure, risk, and strategies. Let's start with step 1, where we'll look at JP Morgan's interest rate exposures. Here we start with JP Morgan's asset allocation from the 10Q as of March 31st, 2025. The key takeaway is that the firm holds large position in available for sale and held to maturity securities, plus loans. To understand the rate environment, we also pulled Treasury yield curve data from Fred. Importantly, the HTM portfolio is longer dated, mainly mortgage-backed securities, which makes it more sensitive to interest rate change. When we compare amortized cost to fair value, we see the impact of high rates. AFS shows a small unrealized loss of about 0.6%, but HTM shows much larger losses of over 10%, or about $38 billion. Loans show minimal exposure. Looking at the yield curve, the 10-year Treasury stayed between 4.3 and 4.6% in early 2025. This elevated rate environment is what is keeping the unrealized losses on held-to-maturity securities elevated. Since those securities are bought when rates were much lower, their market value has dropped.
The insight here is clear. JP Morgan's held to maturity portfolio has significant unrealized losses, highlighting duration risk. These losses reduce balance sheet flexibility and could impact capital ratio if securities are sold. Our recommendations are rebalance toward shorter maturities, expand hedging with swaps to protect against further rate increases, and maintain liquidity by keeping more assets in AFS versus HTM.
Now that we've looked at JP Morgan's exposure to interest rate risk, let's pivot to their equity holdings. These holdings represent another major way JP Morgan's performance ties into the broader market. Let's look at stock market and equity evaluation. JP Morgan's top 4 equity holdings are in Microsoft, Nvidia, Apple, and Amazon. We will be looking at these 4 stocks and evaluating them 3 different ways: price to earning, Gordon growth, and discounted cash flow. Microsoft, Nvidia, Apple, and Amazon make up around 14% of JP Morgan's equity portfolio, with Microsoft being the largest at $53 billion, then Nvidia around $45.6 billion, then Apple around $44.1 billion, and then Amazon around $38.1 billion. There is a clear tech concentration. All 4 companies trade at high price-to-earning ratios, meaning that investors are already paying for future growth. As you can see, the stocks have been color-coded in terms of risk, with Amazon being a medium risk, Microsoft and Apple being reasonable risk, and Nvidia being the riskiest of all 4 stocks.
When we run the Gordon growth model, the results come out much lower than today's market prices, with Microsoft being around $67, Apple around $31, and Nvidia less than $1. This shows that through a dividend lens, these stocks look overvalued. Amazon can't be measured since it doesn't pay a dividend. All 4 stocks have also been color coded in terms of risk level, with Amazon being gray as it is not applicable, and Nvidia being red as being the most riskiest of all 4 stocks.
Our discounted cash flow model shows all 4 companies trading well above fair value. This highlights that while these are high quality businesses, their valuation are very rich. For JP Morgan, that would mean maintaining Microsoft, holding or trimming Apple, trimming Nvidia, and monitoring Amazon closely.
Thank you, Shreya. Let's now take a look at our 2025 quarter one valuation. As you can see, JP Morgan's mortgage related assets are separated into three separate categories: available for sale, hold to maturity, and loans. Our available for sale securities, or AFS, stands at about $401.9 billion. dollars. These are flexible because they can be sold if needed, but they're sensitive to the interest rate changes. Right now, they're showing a small unrealized loss of about 0.63%, which is relatively minor. Next, our held to maturity securities, or HTM, totals about $364.2 billion. dollars. These are investments we committed to keep until they mature. They give us stable long term returns, but the trade off is that they're locked in, meaning we can't easily sell them. Here, the unrealized loss is much larger, sitting around 10.5%, mainly because of the higher interest rates affecting their market value. Finally, our loan portfolio is at $1.3 billion. dollars. This is a very small share compared to our securities, and it has shown minimal change this quarter. So, in summary, the AFS gives us flexibility but reacts to the rate shift. The HTM locks in returns but carries paper losses when rates rises, and the loans remain a very minor portion of the overall portfolio. Now that we've seen the overall evaluation of our portfolio, let's shift the focus to the risk that comes with managing it. Understanding these risks helps explain why our numbers look the way they do and how we position ourselves for the future. First, let's talk about prepayment risk. When borrowers refinance early, it shortens the life of our investment and reduces expected cash flows. This is particularly important for our available for sale security since they're more sensitive to these early payoffs. Next is the credit risk. For the first quarter of 2025, we set aside $3.3 billion dollars in provision for credit losses. This is essentially a buffer to cover any potential defaults that we may have. In total, our allowance for credit losses now stand at $27.8 billion. dollars. Both our consumer and wholesale credit portfolios are being closely monitored to make sure we are prepared if conditions happen to change. Finally, looking at the risk return balance, our held to maturity securities give us a long term stability when our available for sale securities gives us flexibility, even though they react more strongly to the rate changes. Together, they create a balance between safety and adaptability. Now that we cover credit and prepayment risk, let's turn to another important factor that affects our performance: the foreign exchange exposure. Since our business operates globally, currency movements can have a significant impact on both our revenues and valuations. Our exposure comes from three main areas: cross border lending, international revenues, and assets that are not denominated in the US dollars. The challenge here is the exchange rate volatility. Currency swings can directly affect both our earnings and the reported value of our international holdings. When the US dollar is strong, our US based investment looks more attractive, but at the same time, revenues from abroad decline when converted back into dollars. On the other hand, when the dollar is weak, international earnings gets a boost, but the return of our US dollar assets shrinks. These outcomes are closely linked to interest rate differentials and central bank policies. Generally, the dollar strengthens when US yields are higher than the foreign yields, and it weakens when the reverse is true. So, in simple terms, a strong dollar reduces our international revenues, while a weak dollar increases them. That's why our foreign exchange performance is so closely tied to the divergence of global central bank policies.
The first thing we did in this section was evaluate JP Morgan's portfolio against the efficient market hypotheses. The EMH has three main forms. Weak form EMH states that prices already reflect all historical trading data. The semi-strong form says the prices reflect all publicly available information. And finally, the strong form EMH argues that the prices reflect both public and private information. To test this, we used a regression model to calculate Jensen's alpha based on the capital asset pricing model. In this model, our null hypothesis is that alpha equals zero, meaning there are no active returns and the EMH holds. Our alternative hypothesis is that the alpha is not equal to zero, which would suggest active returns exist and the EMH is violated. Our analysis showed a high correlation and low tracking error between the hypothetical JP Morgan CIO portfolio and the 60/40 benchmark. This means their risk profiles are very similar. As you can see from the chart, the profile is only slightly above the benchmark before the January 2025. However, the spread has been widening recently, with the portfolio outperforming the benchmark as of early 2025. Moving on to management strategies, let's start with JP Morgan's quarter 1 2025 performance. The firm had a strong quarter with a net income of 9% to 14.6 billion and diluted earnings per share of $5.07. Total net revenue also grew by 8% to 45.3 billion, driven by both higher net interest and non-interest revenue. Their key profitability ratios were also strong. The return on common equity was 18% and the return on tangible common equity was 21%. The company also reported a 3.3 billion provision for credit losses, reflecting a net addition to the allowance for credit losses driven by changes in the macroeconomic outlook. Moving on to how JP Morgan is managed, the firm's operations are a core driver of its investment portfolio, specifically through the activities of the Treasury and Chief Investment Office. These departments actively manage liquidity and interest rate risk by repositioning the securities portfolio in response to market conditions. The firm is managed through three primary business segments. The first is consumer and community banking, which focused on service for consumers and small businesses and reported an impressive 31% return on equity. The second segment is its commercial and investment bank, a global leader in investment banking, which reported an 18% ROE. Finally, the assets and wealth management segment provides investment and wealth management solutions and had the highest ROE at 39%. Now let's discuss JP Morgan's capital structure, liquidity, and risk management. The firm maintains a robust capital position that is well above regulatory requirements. As of March 31st, 2025, their common equity tier 1 capital ratio was 15.4%, which is well above the 12.3 requirements. They actively manage this capital through our 30 billion common share repurchase program and quarterly dividend payments. The firm also maintains a strong liquidity position to meet its obligations. Its liquidity coverage ratio was 113%, exceeding the 100% minimum requirement. Their primary sources of funding are stable deposits from consumers and businesses. Finally, let's talk about their risk management. The firm's risk governance framework is overseen by the board of directors and focuses on understanding the various drivers and types of risk. Key risks include credit risk, which is evaluated through consumer and wholesale credit portfolios with an allowance for credit losses of 27.8 billion as of March 31st, 2025. They also manage market risks using tools like value at risk to model the potential impact of changes in the interest rates, foreign exchange rates, and other market factors. To conclude, let's discuss JP Morgan's exposure to venture capital and private equity. The firm's exposure to these privately held financial instruments is classified as principal investments. These investments are primarily managed within the firm's business segments and corporate division. As of March 31st, 2025, the aggregate carrying value of these investments was approximately 9.4 billion. The firm's approach is to hold these investments for extended periods, reflecting a long-term investment horizon. The strategy is not to generate short-term realized gains. Instead, these investments are typically made to enhance business strategies or create specific tax benefits. This focus on strategic value and long term returns is a key factor in their evaluation and performance measurement.